Hello and welcome to the fifth and final episode of my 5-week trading bootcamp, a free crash course for those dedicated to mastering trading in the best and simplest way possible. In the last 4 episodes, we have built a solid trading strategy together, incorporating key concepts, risk management and crucial indicators. Today, we will wrap up by testing the robustness of our strategy and analyzing its performance under live trading conditions. If you are new here, make sure to subscribe and join us as we take our final steps to ensure our trading system is resilient and profitable. Let's get started. Before we dive into today's main topic, let's address another common trading myth. You just need to trade one asset to succeed. This myth suggests that focusing on a single asset, like a specific currency pair or stock, will lead to consistent success. But while focusing in one asset can help you to understand its performance deeply, it also comes with drawbacks. First, market conditions change. An asset that performs well in one type of market condition may not do as well in another. So, restricting yourself to just one asset means missing out on opportunities and diversification that could balance your trading performance. Second, trading a single asset can lead to overconfidence and increase the risk. Believing you know an asset's performance perfectly might draw you to take larger positions or ignore warning signs, leading to significant losses when the asset behaves unpredictably. And by doing so, in reality, your best option is to diversify your trading portfolio across multiple assets to enhance your strategy's robustness and increase your chances of long-term success. Different assets perform well under different market conditions, helping to mitigate risks and stabilize returns. For example, looking at our in-sample and out-of-sample results from the last episode, where we tested and selected our filter indicator, we can notice something important. If I had only used the Euro-USD pair for my strategy, the results would have been quite inconsistent. While it produced good profits in the out-of-sample data, it resulted in losses in the in-sample data. This inconsistency suggests that relying on a single asset could lead to unpredictable outcomes. However, when we look at the overall results of our small portfolio with 5 assets, we see much more consistent performance. This illustrates why applying a strategy across multiple assets from different markets is always better than using just one. So, the takeaway is that while deep knowledge of a single asset is valuable, diversification across multiple assets is crucial for a resilient and profitable trading strategy. So, in the last 4 episodes, we created our strategy that includes different types of indicators that work well together and gave us consistent results on our in-sample and out-of-sample data. In this episode, I won't go over the strategy again, because if you have been following this bootcamp, you already know how it works. But if you have any questions, I will leave a brief summary at the end of the video, or you can visit my channel and this playlist, which contains all the episodes. Although our results are consistent, it's important to assess their robustness. For those who don't know, robustness refers to the ability of a trading system to perform well under different market conditions and not just in a specific set of data. Therefore, robustness tests are evaluations that uncover how well a strategy adapts to countless scenarios and market environments. These tests are essential not only to verify the adaptability of the strategy, but also to increase our confidence in it. And by doing so, today I will teach you and show you 3 different robustness tests I learned in my certification at Oxford that you should apply to any strategy. The first one is a robustness test across different assets. This test involves applying the strategy under the exact same conditions regarding entry rules, risk management, time frame and data sample, but on different assets. This test is important to conclude if the strategy works well on other assets and if it isn't overfitted to the initial 5 assets we chose. In my case, since these were always my assets, I will retest the strategy on 5 different ones, including 3 currency pairs, 1 metal and 1 cryptocurrency. This selection should be made randomly. For my test, I will replace Bitcoin with Ethereum and gold with silver. For the currency pairs, I will choose 3 others involving 6 different currencies: AUD Swiss franc, CAD JPY, and NZD USD, ensuring a new diversified set of assets, just like my initial one. Now, I just need to apply the strategy to these 5 new assets, note the results, combine them, and compare them with my previous results. Of course, the results won't be exactly the same, but what we want to discover is whether the equity curve is consistent and shows a growing trend. This will prove if the strategy is well developed and works under different conditions and assets or not. As usual, I will use my indicators testing bot, which I have discussed extensively in previous episodes, to analyze the strategy. After setting all the conditions and indicators in its menu, which is very easy to use, I just need to click on the asset to test, and within seconds it does everything. It places all the trades on the chart and provides me with the results, both in this monthly table and the overall ones in the strategy tester tab. Then, as I showed you in episode 4, I just need to download the trades here and create a new trading journal. If you'd like to know more about this incredible trading tool and also use it to accelerate your backtest, check this link in the description. After taking the results from the 5 new assets, I copied them and created a new trading journal with them. After sorting everything, here are the results. Comparing them with the previous ones, we can see that everything remains fairly steady, from the win rate to the annual profit and even the drawdown values. You can pause the video to analyze everything, but I won't spend much more time on this because looking at the equity chart, we can see that it is consistent and profitable. Of course, it is not as good as our previous one due to this flat period, but for me, the strategy passed this test with flying colors, which is great. It means our strategy works across different assets. If by any chance the strategy had a negative equity curve, this would mean that it will not be robust, and as such, we will have to optimize it by changing some indicator settings. But one thing I can guarantee to you, if you respect the in-sample and out-of-sample data and use a large set of data, as I showed you throughout the bootcamp, you will unlikely have any problems here. Now let's move on to the second robustness test, which involves testing the strategy on different timeframes. As you know, different timeframes exhibit different levels of activity and volatility. While a daily timeframe is smoother, a smaller timeframe has more volatile changes. Therefore, testing our strategy on different timeframes is also a significant test to assess its performance. I created the strategy only on the 1-hour timeframe, so it's crucial to understand if it can adapt to different timeframes that present different market conditions. In my case, based on the data available on my TradingView, I will need to test the strategy on higher timeframes, because I don't have data for smaller ones regarding the beginning of 2022. Therefore, I will choose to test the strategy on the 2-hour timeframe and then on the daily one. Again, the most important aspect is to conclude if the strategy exhibits a fairly consistent equity curve or not. To do this, I will use my initial 5 assets, and to see the results, I just need to adjust the time frame here, and my indicators testing bot will do all the work automatically. I will do the downloads from the trades of each time frame, and I will be right back. After collecting all the results from both the 2-hour and daily timeframes, I copied them and created a new trading journal for each one. First, analyzing the results for the 2-hour timeframe, we can see that they were quite good. The main difference is that the number of trades was lower, but that's normal for a higher timeframe. The equity curve, despite this flatter period, is also well above expectations. Regarding the daily timeframe, the same thing is true. The strategy was one more time profitable and consistent. This not only shows that this system adapts to different conditions, but also demonstrates that if you want to apply it to other timeframes, you can do it for sure. However, one crucial factor remains to be analyzed to predict what results we can expect in live trading conditions. And this is where many strategies often fail. So let's now move on to the third and final robustness test, which is related to the inclusion of commissions and spreads in each trade, simulating real market conditions. In this test, the objective is simple: to understand if even with the inclusion of spreads and commissions, the strategy remains profitable. Typically, this test is done in a forward testing phase, where you apply a trading strategy to real-time market data but on a demo account, without using real money, to see how it performs before risking real capital. However, this stage can last from 6 months to 1 year, making it time-consuming. But with the use of my trading bot, I can conduct this study in just 5 minutes, as I can input both commissions and spreads in this tab called Properties. For this study, I will use only 3 assets, simulating that I am a trader who will manually do all the live trading work. And as such, it might be difficult to trade multiple assets at the same time. But of course, you can do this work for more assets and markets. So I will choose the assets AUD Swiss franc, Bitcoin and silver, creating a small but diversified sample. So for each one, I must now input their spread and commission values. To input the values, I just need to go to my broker to find them. In my case, I will use XTB, the broker I use for trading in my personal accounts and investment portfolios. XTB is a properly regulated broker, where I know my funds are safe. And the best part, there are no commissions, and that's already a significant advantage. In addition, XTB pays interest on the money you have in your account, ensuring additional profits of up to 5% per year. Regarding spreads, to find out them for each asset, we just need to download this document, which I will also leave in the description of this video, and then simply search for the assets we want to use. The first one is AUD Swiss franc, where we can see that on average there's a spread of 1.5 pips. Let's go to the trading view, open the indicators testing bot menu, click on the properties tab, and in the slippage option we will input 15, as 1 pip equals 10 ticks. Now, after clicking on OK, the bot will update everything. On the chart, you can now see that the entry point considers the 1.5 pip spread, and below we have the updated results, which, as you can see, turned into a loss. But don't forget today's myth: the results of just one asset are inconclusive. What matters is the overall results of our portfolio. So let's now analyze silver. Returning to the XTB's document and scrolling down, we can find an average spread for silver of 35 pips, which equals 350 ticks on TradingView. Clicking again on OK, the results decrease but remain profitable. And finally, let's move on to Bitcoin. In XTB's document, we can see that the spreads are presented in percentage form, so we can copy this 0.22% value to our TradingView and input it in the commission part. After clicking again on OK, we can see that the results decrease but also remain profitable. Now I will create a new trading journal with all these results and be right back. After compiling the 3 assets I chose, here are the results without commissions and spreads, and next to them we have the results under the same conditions but considering XTB's commissions and spreads. It's evident that the results decrease, but what matters is that the strategy remains profitable, making an average annual return of above 40% over the years 2022 and 2023, with a 2% risk per trade, which is of course well above the average. And even if you want to lower the risk to have smaller drawdowns, for example to 1.5%, you can see that you would still achieve an average annual return of 30%, which is great. In addition to these results from 2022 and 2023, out of curiosity, I applied this strategy with a calculation of commissions and spreads from the beginning of 2024 until the moment this video is being recorded, to understand what results I could have achieved by trading just these 3 simple assets. As you can see, it will be a profit of around 32% in 5 months. And of course, the more assets I use, the better and higher my results would be. If you want to analyze this trading journal more closely, I will make it available in my free Discord community in the free materials channel. The access link to my Discord is in the description as well. Also, if you would like to try a demo account on XTB, don't forget to use the link that is down below to support my work. And in addition to these 3 robustness tests and these results from 2024, you will also have the opportunity to perform Monte Carlo simulations on this sheet, where by double-clicking on an empty cell and then pressing enter, you will have a simulation of the type of equity curve you could have in live trading. If you don't know, a Monte Carlo simulation is a statistical method used to predict the potential future performance of a trading strategy. And with that, we conclude this episode, where not only I have explained to you how to apply important robustness tests, but also confirmed that the strategy we developed over the past 5 weeks is consistent and profitable, suitable for anyone to implement. Therefore, we have reached the end of our 5-week trading bootcamp, where we have analyzed trading myths, built a robust trading strategy, and tested it under several conditions. I hope that whether you are a beginner or an advanced trader, you have learned something new and gained motivation and confidence to work on your strategy and trading journey. And thank you for joining me on this learning adventure. Remember, success in trading involves dedication and endless learning. Stay updated with market trends and always strive for improvement. In addition, if you enjoyed seeing my working methods and would like to work one-on-one with me to enhance your trading system and become a better trader, you can explore all my available services on my website, algotradepro.org. And now, as promised, here is a summary of my 1-hour strategy that we'll put together over these 5 episodes. This strategy includes the C1 indicator, Dora Stochastic, with settings 12, 18 and 11, which tell us when to enter a trade. Then the exit indicator, which is the Arun with a length of 14, helping us exit each trade at the best possible time. Next, we have the volume indicator, the ease of movement with the default settings, which help us trade only when market volume is high. And finally, our filter indicator, the McKinley Dynamic, with a length of 100, helping us enter trades only when its direction is in line with the major market trend. For our risk management system, we are using the ATR bands with a multiplier of 2 to set up our stop losses, take profits and trailing stop losses. As an example, here is a valid long signal, and here is a valid short signal. In summary, that's it. For more details, feel free to watch this series. And that's it. Happy trading and until next time. Bye bye.